Good morning and welcome to Fast Market. It's Monday, March 25th. I'm Tom White and I'm joined on the set by Alex Coffey. He's a senior specialist of client market structure here at TD Ameritrade. And also, Scott Bauer joins us. He's the CEO of Prosper Trading Academy. Welcome to the show, guys. Lots to talk about today. We were just commenting before we came on air that equities almost rallied back to unchanged here, Scott. Give us your take after Friday's massive sell-off. Do we expect this volatility to continue?
I think it continues in the very short term here because there's still so many things, right on the pulse of the market right here. The two big ones obviously are tariff talks and Brexit right now. You can look at the Mueller report over the weekend in terms of what it did to the market or didn't do to the market as maybe a buy the rumor, sell the news type of event, which may happen with Apple today. Right. But yeah, there's certainly no lack of headline risk. There's no lack of news here. But again, I think it's very short term. I really do.
Yeah, and being short term, Alex, that means something's going to happen with these yields. That they're either going to have to stabilize, stop from falling. Is that the big story to you? Is the yield curve flattening and this massive downturn that we've seen in the 10-year yield?
Well, it's certainly the major story for financials, and you're seeing that those companies are really being weighed on strongly now, and you're seeing them in the correction territory again, falling pretty sharply from where they just traded not that long ago. But it is, I think, the big headline story of at least of the last week, over the weekend and then this morning. But it really we need more information on that front to really know what that's going to mean. And I think that makes data coming out, over the next couple of weeks more important than it has been in a long time.
Yeah, I don't think as far as the yield curve goes, Scott, and the flattening that we've seen, I mean, is this something that you tell your clients? If I'm trading this market and it's being based off the Treasury market right now, it's a difficult one to kind of, parse through, right?
No doubt. And that's exactly why I didn't bring that up in the two things that I said are to me, front and center in the marketplace. Because, Alex, you hit the nail on the head. We need more data. We absolutely need more data. Is this an overreaction in the marketplace? Is it something that's more sustainable? So, Tom, to your question is, we're trading. I'm not investing. I'm trading right now. So the yield curve, yeah, albeit maybe it adds a little volatility to the marketplace, but I'm really not making my individual decisions based on that.
Yeah, and I think it's affecting sectors differently, right? The financials have been pummeled over the last week as we've seen the 10-year fall to 2.43% right now. And that's going to cause some disruption for specific sectors, Alex. But to Scott's point, do you look at this as, hey, I want to invest or I want to trade this market, and that falling yields actually helps volatility and create some opportunities?
Yeah, so it's a difficult thing to really say black and white kind of a thing. So, I mean, as a younger person, I have longer term investments, and I also look at markets in terms of trading too. And I think that's pretty common amongst a lot of people. I mean, you're going to have longer, more passive things, and you're also going to look at trading. But when we're looking at things from a trading standpoint, I think the headline initially, potentially being one of those things that's tied to a recession, has that that bad stigma to it that did cause a little bit of volatility. But Scott nails it on the head when he says it is something that you need more data. It needs to happen for a little bit longer before you really see the effects of it. And when you look at it now, and the 10 years so compressed down to 2.4, it kind of also tells you if you're looking for a return, that maybe would be positive for stocks. So you have different information that's kind of telling you different things, and that's leading to, a pretty choppy market right now.
Yeah, it's surprising because all being said, if you saw what the market did in December, that was on falling yields also. So typically we like to talk, Scott, about risk on trading. Like, hey, treasuries are catching a bid, yields are falling, maybe equities as a risk and more risky asset is the way to go here. Is that always true?
I mean, Alex, you just said it. With the 10-year where it's at, where are you going to put your money right now? And you would think that would be a positive for stocks. I just think that the overhang on the market right now, and again, it could be buy the rumor, sell the news. You have Brexit, you have China. Personally, I think we're going to get through those. But I think a lot of that is built into the market right now, and that's why I think that in the near term here, we still see this volatility.
Yeah, in the S&P 500, if you think about it, guys, it's still positive by over 11% this year. So people have got to really take this little two-day sell-off that we've seen, little weakness at the end of last week, as, hey, maybe this is what happens in normalized markets, and you can make trades based on those if nothing else has changed. Because a lot of the economic data, Alex, has been more positive in February and some of the early March numbers that we've seen, correct?
I would tend to agree with you, and I think that the one thing is, as you kind of approach towards, yearly highs, which we were on as of Thursday, you're going to get those outsized down moves when you get them. When you have lower volatility, that's when that risk of a, asymmetrical move to the downside is going to come into play. And Friday quickly reminded us that we aren't completely out of the woods as far as, different headlines and things that can take this market downwards. And when I think what Scott kind of alluded to is that a lot of the things may be built into the market as far as, Brexit and tariffs as maybe a resolution on the positive front. If you were to get some type of a negative headline out of that, or something would happen unexpectedly, in the short term, that could cause significant volatility, how I look at it right now.
Do you look at it this way, Scott? So the administration gets a win over the weekend. What happens if they start pushing the buttons on China? Because the trade deal is the next thing, besides Brexit, another vote this week. And they start pushing the envelope a little bit like, hey, you know what, we're going to put the screws down on China here and actually not come to a deal. We're going to give them a set of rules, and then they have to comply.
Not being political here, but, that certainly seems like a very viable option of what may happen here. And again, I think that leads right into, for me, the near-term risk in the marketplace.
Yeah, and I think we're going to have to wait for earnings season is going to be another one of those catalysts that starts in about a little over 2 weeks with a lot of the banks. And we're going to get to some talk about financials. But we did have some economic data today, really small. Dallas Fed missed. Chicago Fed National Activity Index missed also. So we're starting to see a continuation of slower manufacturing numbers, even though the services side of the economy is doing well. But let's get into a discussion about what economic events this week are we going to look at as traders going into this week. We've got lots on the agenda as far as tomorrow, especially. A lot of housing data. We've got a GDP number on Thursday. Scott, what are you looking at that's a catalyst for this market?
It doesn't get talked about a ton with the big ones, but I'm going to look at Redbook. I think that is really a solid indication of the overall climate of spending, of the retail environment. Housing starts. What are they going to? Are we going to have some kind of outlier here? I mean, the numbers have been so bad. Maybe we see a little bit of uptick due to the big drop in mortgage rates.
Right.
But I don't think that's going to move the market potentially as much as Redbook does.
You want to see what that on a week-by-week basis. That Redbook is, basically weekly chain store sales, and it's been trending at relatively high levels. And our economy being based 2/3 on consumer spending.
Exactly.
The consumer's not done spending right now because they've got jobs and wages are increasing, right, Alex?
No, I agree with Scott there, and I also think that makes consumer confidence an important number this week. But as far as the housing data, I think that if you were going to get some type of a very disappointing number in any of those things, given that we had such a decrease in these mortgage rates, that would be one of those things that maybe the red flag slowly starts coming up that, there might be something more to this than, maybe just a short-term blip. But you haven't really seen any great housing data. It's been better than it was over the last couple of months, but nothing's been really great there. So I'm not expecting anything to really fundamentally change, probably more of the same on that. But I think any type of a major outlier in those numbers to the downside would potentially be a warning sign.
Yeah, and speaking of housing, because there's a lot of housing data this week, and I don't, to Scott's point, I don't think the falling mortgage rates on the 30-year fix went from 5.1 down to 4.2% over the last basically 4.5 months. I mean, that's going to be a boon for this industry, but they just don't have the inventory where people want to buy at this point. But we'll get some housing data. A lot of that's backward looking. I wanted to kind of bring up on that housing talk. We did a couple example trades yesterday or on Friday. Kevin did, and a couple of those names were D.R. Horton, DHI, and also I believe they did another one in PHM, Pulte Homes. And what they did, Scott, was basically they looked at a couple of diagonals in here. So stock replacement type strategies. And we've got both of those up here, down here at the bottom. They're buying May, the 39 calls that are in the money, and selling the 43 calls that are out of the money to the upside. They're not doing bad at all. The stocks are still doing okay. But that setup where you're trying to pick bottoms in names by doing stock replacements, you're not collecting those dividends. Do you typically like to look at that or a covered call strategy to take advantage of a grind higher or stabilization?
I'd probably look more at a covered call strategy, quite frankly. I think it's been, especially in the housing market, it's been real easy to pick bottoms, and it's been real easy to pick more bottoms and pick more bottoms. So, you know, that's kind of a sector to me that has been a real difficult one. So I would look at a covered call strategy. If you do like the upside, that could be a potential nice setup for kind of a call calendar instead of a stock replacement, an upside call calendar.
And that makes sense because the volatility in like D.R. Horton, for example, is not exploding.
No.
It's a little bit higher than maybe we've seen lately just because it's, the sector's been hit. But it's up again today. It's at 41.5. Alex, to what Scott was talking about, the covered call versus that where you get to collect the dividend. See, 1.45%. So you get paid to hold that stock, but it's more capital intensive, right?
It is a little bit more capital intensive. That's really what it comes down to. You know, the opportunity cost of the two things. So one, do you want to collect that dividend looking at about 1.5% on the yield on there? Or do you want to go into that stock replacement? It really just depends on, you know, what you're looking for and how really, I guess how big that conviction is in the direction, because you do obviously have a little bit more risk in terms of downside in a covered call strategy as well.
Yeah, and I kind of wanted to have us look at this on a comparison type where we'll hide our positions here. But this is a covered call. So the strategy looks the same. You just don't get to collect that dividend, and it's a capital requirements because you are buying those shares. So that's a good comparison on a note like that. And they did the same thing in Pulte Home. Also. So trying to take advantage of, hey, these lower interest rates aren't going to hurt the housing market, that's for sure. It's actually going to probably provide some tailwinds. And from what the price action of the yields is showing, we're not going to see those interest rates rise anytime soon. At this point. So we'll have to keep monitoring those positions, but that's a good discussion on covered calls versus stock replacement on that. Let's move into a discussion about earnings, because we got earnings coming up in a couple big names. Earnings season doesn't kick off unofficially until the second week of April. So we're looking for those bank earnings. We're going to talk about those in a little bit. Anything on your radar, Scott, as far as earnings goes that piques your interest as a tradable product?
You know, Cronos, obviously, it's front and center in the, you know, in the cannabis sector. And tomorrow morning, to me, I look at that chart here, and the only thing from a technical standpoint that I see there, and obviously there's not a ton of data out there, is that there's some really, really good support in this stock around the 18.5 level. You look at that jump that it made just in a month or two from the 10-12 level up to 18-19 there. And it was pretty meteoric, and it happened really quickly. So I look at that 18.5 level there and say, if anything, I would want to place something, you know, for earnings off of that. I think the expected move is somewhere 9 to 10%, so around $2 or so. So you're looking at, you know, an expected range of about that 18.5 level up to maybe 22.5, maybe a little bit closer to 23 here.
Yeah, and we've got that, the stock's trading about $20.70. We did see that rise. They've got that huge, massive investment from Altria, $1.8 billion as an investment. You know, they don't provide a lot of revenue at this point. It's a growth stock. It's about expectations moving forward, whether states, you know, legalize cannabis here as a whole. The U.S. There's a lot of optimism in this particular space as far as, you know, the growth of this company and a lot of the products that it can provide. Alex, when you look at this and you look at the stock float, it's only 178 million shares. That's a concern for me, but I'm pretty surprised at a stock that moves as much as Cronos does and has a small float that the anticipated market maker move up there only about $1.70 plus or minus. Are you surprised by that low volatility?
It is surprising, but I think that just kind of, to me, says that I look at these companies, these announcements just aren't as important because there is so much just kind of hype into them in terms of the long term. They're not expecting much out of it and the current time period. But this is definitely one of those names in an industry where you definitely want to keep defined risk, because you do have risk of outsized moves. And I don't know if I would want to be overly directional on something, because if they do something disappointing, you could really see a down move, and if something was very, very hopeful coming out of it or very positive, you could really see an up move. So to me, this is one of those ones where unless you have a conviction, maybe as a sit on the sidelines or do something pretty small.
Yeah, and I'm looking at the implied volatility that we have here on the chart, and you can see that even going into earnings, we've only seen a little uptick in implied volatility. That's pretty surprising to me. With a stock that has that ability to move as quickly as it can. And one of the things I looked at going into this, as far as trades, example type positions, because that anticipated market maker moves so low, I came up with a simple strategy that I like to play when I think volatility is too low for a potential move in there. And it's buying a straddle or buying a strangle. I'm going to look at kind of both of those guys. You can help me break these down a little bit, Scott. Here you're paying roughly about $2.13 for the 20.5. You buy the call, you buy the put, you're long both of them. Time decay works against you, but you can put them on in low volatility environments for relatively inexpensive. Now, this is just outside that anticipated market maker move, but you got 4 days in this particular trade. And there's the setup as far as the Analyze tab goes, and we'll set the break evens on that, guys, to the end of the week. So you basically got 22.60 down to 18.38 as your break even points. So if we do get that outsized move, this takes advantage of it, right, Scott?
It absolutely does. And the one thing that would concern me here is not the upside. I think it's great potential to the upside, but on this straddle position here with that big support in the stock around 18.5, if that holds there and the stock hovers there, you're looking at maybe at best to break even. But like you said, though, with the lower implied vol coming into earnings, this absolutely gives you a good opportunity to take advantage of some outsized move.
Yep, and I think this is in a lower volatility environment, Alex. And I also wanted to bring up a different strategy using that same concept. So you've got this straddle right there, but sometimes we like to talk about strangles. So maybe I go out to the 19.5 puts and I buy those because it's out of the money, and then I'm buying. I want to go the same distance, so maybe a buck to the upside too, 21.5. Now I'm paying less, about $1.28 for that strangle. Let's go ahead and analyze that and click off the straddle. So it flattens out here, guys, a little bit, but my break-evens aren't too far outside that range.
Right, they're just outside of the range you had with the straddle.
Yeah, so I can pay only $128 per spread on that, Alex. Is that something that you'd rather do with the break-evens basically the same?
So I want to basically start with, this is not necessarily a strategy I would ever begin as a default in an earnings announcement, or really just in general, because it does have that time decay working against me. But with the setup that we have in this one, a stock that has a history of outsized moves, in general moves a lot just off its low float, but also it's such a new industry, a lot of momentum. I look at this and with the low volatility that kind of feels low, it does seem like something that you could look at either one of these strategies. I may actually sell something to make these, kind of like an iron Condor, but in reverse, to get some more, just make it a little bit more strategic. So,
well, give me an example there,
like
Alex.
If we were looking at, like, kind of almost combining these. So if you were buying the straddle, like the 20.5,
okay,
maybe you go down then after and you sell the 18.5 put.
Okay.
Against that, and then also
in the same cycle, right?
The same cycle, and maybe the 22.5 with it. Make it $2 wide, and you're kind of just long a vertical spread going both ways. Just to, you do limit then the upside, but it gives it, reduces that amount that you're spending, and it makes it slightly more strategic in terms of that you are.
So you want to sell the 18.5. What's the call you want to sell?
22.5.
22.5. Okay. So this lowers your price on it. You're still buying the straddle. But when you're selling a strangle against it.
You maybe not, then you only have 60 cents in upside then in this. So that would be the only thing that is a downside on that. But
and it's called tough. An iron condor in the platform there. But there's where you get you still have some risk on it because you're paying a debit for that particular trade, and it limits your wings too. So if we do have that $5 move either way, you're not going to make as much profit. But your reasoning behind this as opposed to just doing the strangle?
Well, once you actually price it out, and it's $1.42. It isn't as appealing as it maybe was in theory. So when you look at that, maybe it's a pass from a risk-reward standpoint.
Yeah.
So when you limit that upside versus your risk, it does make it slightly more strategic, but it isn't as appealing when you can only make 60 cents.
And Scott, to your point on that not being as strategic, and that's why I kind of set up the straddle. That's why we wanted to look at the straddle as instead of doing like a double diagonal or this, in this case, this iron condor, because there wasn't a lot of premium in those outside options, and that's probably the trade-off, right?
Absolutely, and I would actually take the complete opposite of this, and this is why Heinz makes 57 varieties, right? and we could all be profitable in this, and I would actually sell the iron condor.
Okay.
Even though premium is lower than typically coming in
Would you
here.
sell that straddle at the?
I would not sell the straddle because I don't want to have unlimited risk.
Okay.
I
So what
would have
strikes
to buy
would you use to sell?
I would sell actually the 19.5, 18.5 put spread.
Okay. There's a $1 wide. Okay.
Yep. And just do a $1 wide call spread like 22.5, 23.5. I think that's going to price in somewhere around 40 to 45 cents.
Okay. So there's this short iron condor here. This is where you actually collect that credit, Scott. It's $1 wide on each vertical, so you've only got about 56 cents in risk on this particular trade. So let's go ahead and analyze that one. This is a great discussion, guys, as far as different types of strategies.
There you
I'll go ahead and click that off. And here's the iron condor. This is where you're taking advantage of that time decay and a little bit higher elevated volatility in this particular name before you put it on. And you've still got those break-even, Scott, of about $23 and 19 bucks on the downside.
Right, and I definitely like the downside break-even because, as we talked about before, there's some nice support there. The upside, kind of irks me a little bit, but nonetheless, Alex, and you made this point earlier, completely risk-defined, especially in a name like this.
Yeah, and this is more of a traditional default for me as far as where I'd go for earnings if I don't have a conviction as far as a direction, and it is taking advantage of volatility as opposed to and time decay as opposed to actually having that worked against you. So and you look at these particular names too. The earnings announcements aren't as big of a deal in a company that has more of a long-term trajectory, and so that could work to your advantage as well.
Yep. So I went ahead and we're going to put in 4 of those just to show some management on the trades. But then also, I kind of want to do both of them just to give our viewers, when we manage this tomorrow, I'm going to buy a couple of the strangles too to see how they both look tomorrow, because I think it's a good lesson for our viewers as far as trade management skills and different strategies that you can put on going into earnings. So we'll let those go ahead and work. I just wanted to bring up one thing here, guys. Apple, Kevin and I believe.
Is there something going on with that?
Apple maybe has something going on in here. And last Friday they put on a long calendar in there. We can look at the Analyze tab on that position. They bought the 185 put calendar on this particular name with a little bit of downside in there. And stock's down a little bit today, trading about 189.76. So this thing's working out all well already. But let's take a look at the position. So he's short the 185s in the March 29th, long the April 5th weekly. So just a 1 week wide calendar. Let's go ahead and price that out and see what it's trading, because they paid 49-cent debit for it. It's trading 72 already, Scott, with news out in about an hour and a half.
I take half off.
That's a great way to
manage my risk, take half off, and then leave the rest go for a little bit here. If you look at it, you're looking at probably...
We've got a 5 lot, so maybe close 2 or 3.
2 or 3.
Okay.
In a 4 or 5 hour of open market trading, this thing has made 50% or just over 50%.
Right.
Right? Especially you're going into the news event right now. If it were not a news event, well, you probably wouldn't have been able to get into this where we got in the first place.
Yeah.
But there's a news event going on where anything can happen. That old adage, bulls and bears prosper, pigs go to the slaughter.
Yeah.
Take a little bit off here and then let the rest of it
And that's
ride.
why I wanted to bring this up for discussion, because I think it's a great way to manage trades. It's like, oh, okay, the stock's down because when they put this on midday and on Friday, the stock was only down about a buck and a half. It's moved down lower. It was down $4 on Friday, moved another $1 lower. So I think that's great trade management skills, just to reduce some of your exposure try to get lock in some gains on what you have, and then if that event comes out and the stock does fall a little bit, then it's probably going to be a bigger winner at that point. But then you're taking off some risk in case this is a blowout event. So great trade management skills there on that one. So we'll go ahead and work that. I put it in a little bit higher at 75 cents. So we'll get to that and see what happens in this event that Apple has coming up at 12 p.m. Central Time. All right, guys, that does it for this segment. We've got Face Off coming up. Brent Moores joins us. He's going to take a look at J.P. Morgan as the banking stocks have been taking a hit. Stay right here on the TD Ameritrade Network. Fast Market will be right back.